Hey guys, this is Mr. Oxy coming at you from Palm Beach in Florida. It is April. It is the 2nd. It is the day after April Fool's Day. I decided not to make a video yesterday, otherwise you probably would have thought I was just making a joke and I wasn't being serious. But as you know by now, I don't have a sense of humor and I need to make serious videos. And I definitely should refrain from telling jokes and telling funny stories. So on a serious note, it is April the 2nd. It is 6:30 p.m. So the markets have long closed. But what I want to do is to sort of take you into my energy portfolio and give you an opportunity to maybe contribute and tell me sort of how correct or skew my thinking is, and maybe talk about some of the things that I could do or should do, and maybe you have some of the same stocks that I do in your energy portfolio. But what I want to do is first just share a little bit of news with you. So I'm going to share my screen. Let me just figure out how to do this because, as you know by now, I'm completely technologically challenged in terms of doing this kind of stuff. So I'm going to take you inside my energy portfolio, but let me first start from the beginning of this particular presentation that I put together for you, and just to kind of lighten up the mood a little bit because it's Friday and we're going into the weekend. And by the way, I got the weekend off, which means I don't have to work this weekend, which means I'm doing this work for you and for your entertainment. But before we do any of that stuff related to my portfolio, let's first take a look and see what's going on in the news, because the news media, and especially the mainstream news media, should either be avoided entirely or otherwise just used for your entertainment. So here's some examples. Offshore technology says oil prices edge down as the third COVID-19 wave hits Europe. That was just a week ago on March the 23rd. RT, on the other hand, earlier today, on April the 2nd, says global stocks shoot past their all-time high of 106 trillion as the imminent end of the COVID-19 pandemic heats up market sentiment. One of those two might be correct, or neither of them might be correct, but I'm just here to report. You decide. How about this one? Everybody knows that the Guardian out of the UK is one of the most reliable sources of good information, right? So just a short while ago, the Guardian informed us that the Suez Canal gridlock could raise oil prices and shipping costs. And just earlier today, Market Insiders, which is Insider is a division of Business Insider, said oil drops after the Ever Given container ship blocking the Suez Canal is refloated. So interesting stuff here, right? The Suez Canal is blocked, therefore oil prices should go up. The Suez Canal is unblocked, therefore oil prices should go down. Maybe. How about this one? CNN, the most reliable source of good information in mainstream media today. Everybody knows this is CNN, the trusted source, right? CNN Business reports oil prices surge as OPEC and its allies extend production cuts. A short while later, via Bloomberg, Yahoo Finance says oil rises after OPEC agrees to boost output gradually. Oil prices surge based on production cuts. Oil prices rise after OPEC agrees to boost output gradually. CNBC, another source of trusted information, says oil prices jump as OPEC keeps production largely steady and Saudi Arabia continues a voluntary cut. Meanwhile, RT News today says oil rallies after OPEC's decision to gradually increase production. Hey, make of that what you will. Let's rather, on a much lighter note, no joke, jokes aside, go inside my energy portfolio. Let me tell you what's going on here. So underneath my pretty face over here, the 6% that's sticking out on the top right of your screen is Total. And then if I go counterclockwise on this one, I'm going to say Enbridge is at 17%. And then I have a group of nuclear, uranium miners and energy companies like bunched together there. Cameco 6%, 3%, Goviex 3%, Paladin 9%, Energy Fuels for 21%. By the way, they all actually started out at 3% each. but some of them have spiked quite a bit, and that's why you have this variance, 6, 3, 9%, etc. Energy transfer at 14%, Pembina at 16%, and Occidental at 26%. So what started out as sort of 5 slices of this pizza pie. And by the way, it's Friday, so I thought I may as well bring pizza into the conversation. Since it's kind of supper time on the East Coast of the United States, you may as well think of pizza. But anyway, what started out as sort of 5 tranches of an investment at approximately 20% each is now a little bit skewed, right? So I have my uranium allocation at about 21%, which is fine. Have energy transfer and Total together at about 20%, which is kind of okay, but maybe I should pick one and not both, or one and not the other. I'm not sure yet. Enbridge and Pembina at about 20%. And then, of course, Occidental has spiked recently. So now Occidental is at 26% and kind of setting the trend in terms of the growth on some of these equities that I hold inside my energy portfolio. How about if I sold Total? So one of the reasons why I invested in Total in the first place is because it pays a nice, hefty, fat dividend of almost 7% on an annualized basis. And you will see over here in my green circle that I drew, the ex-dividend date was March 23rd, but the dividend payment date is coming up soon. It's actually on April the 19th. The reason why that is important to me is because all my stocks are enrolled in a DRIP, a DRIP, which is a dividend reinvestment program. When I receive a cash dividend, it automatically gets allocated to buying me more stock. So in this particular instance, I might think of exiting Total, but at the same time, what I want to do is first collect my dividend, which is going to be paid on April the 19th, and then possibly look at exiting Total. That's based on the assumption that I should exit Total in the first place. How about energy transfer? Maybe I should exit energy transfer. Of course, if I exited energy transfer and Total together, I'm going to have a cash awaiting investment position of almost 20% unless I reinvest it into something else right away. One of the reasons why I invested in energy transfer in the first place is because I viewed energy transfer as a proverbial parking lot for cash awaiting investment. You'll notice that energy transfer in my green circle over here also pays a nice healthy dividend of almost 8% this time. But in this particular example, energy transfer dividend, ex-dividend date and dividend payment date is in the past because I've already collected this dividend, which bought me some more stock of energy transfer. So that happened in the past. So I'm less concerned with exiting energy transfer at this moment in time because I've already received my dividend and I don't have the issue that I just explained as it relates to Total. But there are other reasons why I might be interested in potentially exiting energy transfer. Now, I'm already up on my original position, which I opened about a month or 6 weeks ago at around $7 per share. Added with my DRIP, which is the dividend reinvestment program for the dividend payment I received for the end of the first quarter. I'm up about maybe, I think 12, could be higher than 12, but I'm up about 12% on my energy transfer position. The problem with energy transfer is that they own the Dakota Access Pipeline, and this pipeline generates approximately 17% of energy transfer's annual revenue. Now, the next DAPL, so the Dakota Access Pipeline court hearing, is slated for April the 9th, which is next week. And the expansion and the pipeline is still working and still progressing. So everything is kind of like business as usual, but we don't know what's going to happen on Friday of next week. Energy Transfer Executive expressed confidence that the much litigated Dakota Access Pipeline will remain open. They actually describe it as an essential service. But yet we notice that some other organizations like Carnation has said that they have a workaround because they have other pipelines that actually takes it around the territorial area that is being disputed by the First Nations group in that particular pipeline litigation case. And of course, we have no idea what President Biden is going to do. And you may jokingly say, well, nobody has any idea what President Biden is going to do, including President Biden. But the fact of the matter is this. As President of the United States, he can actually wield a bit of muscle. And if he cannot wield a bit of muscle, he can certainly wield his pen. But at the very least, he has the ability to influence people's thinking and perhaps where we should be going and what we should be thinking about as it relates to the Dakota Access Pipeline. We know that within a few days after he took over as president of the United States, he pretty much took his pen and struck through President Trump's approval of the Keystone XL, which was an extension to the existing pipeline. But anyway, he wanted to make a case and prove to his electorate and the people who supported him that he means what he says, and he promptly canceled the XL extension to the Keystone pipeline. He's been mum about the Dakota Access Pipeline, but at the same time, the philosophical debate and discussion that they've had around fossil fuels, energy, and pipelines in general has not been conducive to being beneficial to organizations like Energy Transfer, who own the Dakota Access Pipeline. Now, the executives are saying it's an essential service and they believe it's going to be business as usual. I am not so sure. So for that reason, I'm actually potentially looking at exiting Energy Transfer even as soon as this week coming up. If I were to do that, my Total position, which is now hidden kind of behind my little picture here, so if you ignore my pretty face for a minute, that Total position would be zero, much like the Energy Transfer position would be zero, assuming I exited them both, and then I'd have 15% cash awaiting investment. But then I still have this unbalanced position in Occidental, which now edges up to almost 30%. However, I have, and just for the sake of example, I'm going to say I have about 100 shares of Occidental that I purchased originally at $48 a share. So I'm using that as an example, and it's going to be clear as mud to you on the very next slide, because if we talk about tax harvesting, and let's imagine just for a second that I sold my Total and Energy Transfer and made $1,800 as a profit. There's a reason why I picked that particular number, which is going to be clear any second now. We know Oxy is trading at about $30, and I just mentioned that I previously purchased some Occidental shares at $48 per share. So if I had to sell my Occidental shares, which I purchased at $48 a share, for the current trading price, which is around $30 a share, I'm going to make an $18 loss per share on paper. Therefore, if I sold 100 shares of Occidental at $30 from that particular lot or that particular tranche of my investment, I would book on paper a $1,800 or $1,800 loss. Therefore, in theory, using this example, my Total and Energy Transfer profit would equal my Occidental loss. And my tax harvesting example here is the fact that I generated a taxable gain of $1,800 and I generated a taxable loss of $1,800. One minus the other is zero, which means my tax implication is effectively zero on this particular trade if I chose to rebalance in this manner. However, there are another couple of things that you need to be aware of. So earlier on, I talked about the Total dividend, which is going to be paid out to me later in April. And I want to receive that dividend and have it reinvested into shares before I potentially exit the position. So effectively, in theory, Total would be an exit later than Energy Transfer, using the example I just discussed. But the other thing to keep in mind is that I potentially could trigger a wash sale because Occidental's dividend is due to be paid out on April the 15th. And as I've just mentioned, my stocks are invested in a DRIP or enrolled in a DRIP, which is a dividend reinvestment program. So even though the dividend is only a penny per share multiplied by a few thousand shares, that's money, and it buys me some Occidental shares, which is going to happen on or about April 15th. So I do not want to sell Occidental, any Occidental at any price, and then within a few days after that, buy some Occidental because I'm going to trigger a wash sale and I will not be able to write off my loss. So these are things that you need to be aware of and keep in mind as you seek to rebalance your portfolio, as I'm doing and discussing with you right now. So let's say, just for the sake of argument, I want to have 5 stocks and I can group some of them together, like my uranium example, which is 20%. And then I want to have 4 others, which are 20, 20, 20 each. Right, so I'm going to have like 20% of uranium, 20% of Occidental, 20% of Pembina, 20% of Enbridge, and I might have 20% of cash awaiting investment, or otherwise right now I have cash, a position of 20% in Energy Transfer and Total together, right? So that's the one that I'm busy discussing. So I want to kind of rebalance my portfolio and make sure that I balance things out so I don't get into a position where I have a concentrated position in one particular equity, in this case, Occidental Petroleum, which is now edging up to 30%. But I need to be aware of quite a number of different things. Firstly, I need to know when the ex-dividend date is. I need to know when the dividends pay out because I'm enrolled in a DRIP and it's going to buy me some stock. And I don't want my stock acquisition to cancel my loss on paper because effectively that wash sale will put me in a position of taking away my loss situation, and then I'll end up with just a taxable dividend or taxable income that I have to pay taxes on. So if you want to use tax harvesting as a methodology in order to minimize your taxes due, and of course, it's perfectly legal to say, I made a $100 loss and I made a $100 profit, and the one mitigates or cancels the other, and therefore I do not have to pay any taxes. You just need to be aware of these things, right? So know when the ex-dividend date is, know when the dividends are paying out. If you're in a DRIP and you're going to be buying stock with that dividend, don't also do a disposition at a loss at the same time because you're going to trigger a wash sale and you cannot write off the loss. So on that happy note, guys, this is Mr. Roxy saying thank you for watching. As usual, I do appreciate the fact that you're watching. If you haven't subscribed yet and you enjoy my videos, please hit the subscribe button. It helps me a lot and also gives me motivation to keep doing what I'm doing so that you don't have to. So stay safe. I need you to take care and stay away from COVID. Stay healthy. And I will be back soon with more content and more information. In the meanwhile, I look forward to your comments because I'm sure many of you actually own some of the same stocks that I do. So on that happy note, this is Mr. Oxy saying stay safe, stay away from COVID, and take care, and I'll be back soon. Bye-bye.